The yeah, my name is Daniel Fehr-Krahn. I am out of Winnipeg, and I'm excited to be here. We're going to talk about really the core of our workshops and the core of kind of what we do and what we represent. And I'm just going to make sure my stuff is showing. And if you're at home, if you're on a phone or a computer, even if you're at work or wherever you're at, you probably want to spotlight me, where instead of sharing a second screen, we're going to share the screen just like this right into my window. And then I'll pop myself on right in the corner here so you can still see me. Sometimes I might sneak behind it like this too. But we're going to go through proper protection and get you the information that you're looking for, both on how to purchase the right insurance for your family, your loved ones, your beneficiaries, as well as how to market it and to help someone else make a decision. And I think the number one thing you can do is help someone understand what their options are. But the funny thing is, you can't, it's very hard to actively help someone understand. They have to want to understand, they have to want to come here and learn. And their desire to learn is a big part of it. So without any more introduction, you don't want to come here and hear about me, but we're going to jump in about proper protection. I got started in this industry, just to go back for a second, I got started in this industry really to talk about insurance protection. I was excited about it. And that was back in 2006. And so that was over 15 years ago. And it's been a real blessing for me. I got a wife and two children, and one on the way. And we haven't had a job in a long time, haven't had a boss in a long time. So it's been a real blessing that way. But let's jump right in here. By the way, this is not, you guys aren't going to buy something at the end of this workshop. You're not going to be in a position where, you're offered something. We want to make sure it's non-solicitous and we take care of what you're looking for. Let me highlight my screen so I can see, so you guys can see me. If I remove my spotlight and add a spotlight, that's probably a little bit better. But financial education in 2024 isn't really an option. We want to educate 30 million families. You are one of the 30 million families that we're going to be tracking and adding to we have a counter. And we think that, we want to build a system that bridges financial education and financial independence. There's a big gap between learning about money and being totally financially independent. And a lot of times it starts with some education, and then you add in some vision and maybe a big dream and some discipline. And a lot of good things can happen. But every day we're flooded with information. There's too much information out there. We don't need it all. And so a lot of times we want to figure out, what do we really want? What do we want to learn? And what is the process we want to go through? But we want to educate and help you become your own money manager. And so you can control your finances, take care of your future. And what you're going to learn today, we're going to go through what's called the X-curve concept. And then we're going to talk about why proper protection is the foundation of what we call a financial foundation. And then the value of properly protecting your assets and your liabilities, what it looks like for insurance, and then how this benefits your overall strategy. So let's jump right in here with the main concept that we teach a lot of. It's called the financial foundation. We have a workbook. And so if you are just plugging in, we have a workbook, looks like this, financial education workbook. And in our workbook, when we open it up to page 26, we're going to see something that looks like this, blank, because we want you to take notes. You don't have to take notes. It's not a requirement, but that is there for us to take notes, to look at the financial foundation. And really, it looks like different areas for you to put your money, whether you're buying insurance or protection with your money, paying off debt, building emergency funds, or investing. And we want to look at, hey, what does this look like? What are our options here? And then how can we look at this to say, someone might say, why should I buy insurance when I don't have too much debt? Or why should I buy insurance? I don't have enough money saved. Or I'm not investing yet. I should get the insurance. And so every industry kind of has its own agenda, where the investment industry says, what is your net worth? The banking industry says, how much cash do you have? The line of credit card industry just says, hey, what is your payment? And then the proper protection says, hey, what are you worth, but what are you worth in a crisis? Where I think the value of money when you have some goes down, but when you have none goes up. And so we want to be in a position where the right protection, where the right amount of money shows up at the right time and in the right amount. But we're going to talk about this today. We're going to talk about how much coverage someone should buy and what types of coverage there are. So the X curve is a concept that can show the relationship between taking care of your responsibility and building your wealth. It theorizes that in general, a person's responsibility decreases and their wealth increases over time. So the black line would be your responsibility, and the bluish line would be your wealth. Now, it provides a clear approach to looking at building your financial foundation, where if I buy too much insurance when I'm young and I overpay, many times I can get a lot of that income back later in life. Where when I'm young, we got to look at a lot of people where they have children, mortgage. I talked to a family this week that a young family, one job, one child, they're married, just trying to make ends meet. And over time, that responsibility they have should go down. But the wealth curve over time should go up. And so one of the questions with insurance is it okay to save money in an insurance policy? That's one we're going to come up with a little bit later. But whether your responsibility is going down or your wealth is going up, where you save it, it should be almost like many pockets of savings. We should say, maybe we should have some savings in our insurance, some equity in our home, credit card paid off, some in our RRSP, some in our TFSA, some here and some there, in different places to store money. And so generally you're less secure when you're younger, and generally you are more secure when you are older. More is in your textbook, and then older and taking care of your future are questions in your textbook that we're replying to. So as we look at this, we want to look at some of the quizzes that are here of, according to the X curve concept here on this side, should I wait until I pay off all my responsibility before building wealth? And this is a question some people say, hey, I'm going to wait till I have a lot of money saved, or I'm going to wait till I'm out of debt before saving. We should do it at the same time. And according to responsibility curve, you have more responsibility when you're older. False. You should have less responsibility when you're older. That's why if I want to retire in my 40s, I need a lot of money because I need 50 years of income. And generally, when we're young, we may have enough wealth to take care of our responsibilities. Very few people have enough money to take care of your responsibilities. So let's look at this. What are the most common things you insure? Let's just go through the idea of insurance. Some people maybe they say, I don't believe in insurance, and they don't maybe believe in the idea of it. Well, we all like to say, I have insurance on my car, I have insurance on my health, I have a warranty on my phone, I have house insurance, I insure my rings, I insure my vacation, I insure my dog. And insurance is really like a warranty. On a small scale, it's a warranty, but on a big scale, it's insurance. But it's basically I pay a monthly fee to something. In exchange for that monthly fee, if something goes wrong, money shows up. And it always shows up at the right time, which is in a crisis. But we're going to look at life insurance is insuring your life. Maybe it should be called death insurance, or maybe it should be called something else. But really, the word life insurance is what it's called. And in exchange for premium payments, the insurance company provides a lump sum payment. Now, one of the controversies when it comes to insurance is, what type do I buy? We're going to get into that. Or what type is the best? What type is the worst? The type you buy has to match your purpose. So if I'm saying, hey, if we're dealing with maybe a lower income and they just want to protect their income, well, a certain type of insurance does that very well. If someone wants to leave an inheritance to their children, a different type does that very well. Or maybe you want to build up cash value quickly, it's a different type. But let's say I want to give to charity. And I want to say, instead of giving a monthly amount to my church or to an organization, I want to give a big lump sum. Well, the amount you buy, what you buy matters. Or a state equalizer. This means you really support one child, or if you have a business, let's say I have a mechanic shop and my son wants to be a mechanic, but my daughter doesn't. Well, insurance actually allows me to recognize all my family members. So I can recognize my daughter by giving her some money, and I can recognize my son by giving him my mechanic business, or, if it's financial services, but I can equalize some gifts that are going out. In business planning, if I own a business and my business is worth $1 million, when I die, that becomes a capital gain that my family is going to pay tax on, unless I got a spousal rollover. But if it goes to my children, it could become taxable. And if I got another million in cash in my business, that $1 million gets a second tax. It becomes a part of the value of the company. So I want to maybe put that in insurance to avoid double taxation. Maybe you just want to create wealth. And we're going to talk about this I think the number one amount of wealth that you can give somebody isn't a couple $100,000 or $1 million or make them financial independent, but it's really an issue of giving them enough that they can have a reset. That earlier in my life, in my 30s, if someone were to give me a reset of 30 to 50,000, 30 to 50,000 would put me in a position where I would have total control, gain control back on my life. So if my children, I think maybe 50 or 100,000, they can maybe exit a bad relationship. They could get into a good marriage. They could buy a house, pay off a car loan, pay off a business loan, pay off a student loan, go back to school. So the amount of reset is really an issue of, hey, my children should be able to run their whole life. Maybe when my children become an adult, with the day I pass away, I want to leave them an inheritance, right? Another purpose that we don't talk about enough is offsetting retirement income, where if I have permanent insurance, or if I have any life insurance, I can spend all my money and then my wife is repaid to restart the retirement with insurance money. But we look at different questions of, why is some insurance so cheap? What am I getting? Who's the beneficiary of the insurance policy? Is the ad real? Will it be there when I need it? What ways do I lose this thing? And so a lot of times when we look at these types of policies, people don't know the answer. And if they're confused, they don't move forward. They just say, I don't believe in it. But I think if insurance can be overwhelming, and a lot of people are trained with sales tactics to create a pressure, nobody wants to talk about too much sales pressure. And so what I want to go through is how premium is calculated, how much coverage you should have, and then how do you pay for it by choosing a type of insurance. So when you look at insurance, they want to make it fair. One of the few things in the world that I think should be fair: the older you are, the more you pay. The heavier you are, the more you pay. The more health issues you have, the more you pay. Medications, tobacco use. We had someone come in today, we got a policy and they have some cancer in the family, and so their health history is increasing their premium. And so the more likely we think you are to pass away, the more you pay. And things that are not factored are things that don't matter. So we're allowed to discriminate. We just can't choose things like hair color, religion, eye color, riding a bicycle. So we can discriminate based on things that matter, but things that don't matter, we don't discriminate. And that's for the Human Rights Code, insurance is allowed to ask questions that are very personal. The greatest sin in financial planning is not getting enough insurance, where people buy the type they want, but they don't get the right amount by adding a term rider or getting the right benefit. But if you buy insurance to have a potential loss, no one will buy 100,000 coverage for a $500,000 house, or $20,000 coverage for a $50,000 car. So why have $100,000 coverage if someone's worth 500,000? So here's how you calculate dime. This is how we look at it. We look at, do I want my debt paid off? If I do, I include that in my calculation. Do I want my income times 10? So when I look at a 10 times income, we might be looking at, let's say my income is 100,000. I might need $1 million to protect my family. But this is also subjective where my wife doesn't work and I have 2 children. My wife is pregnant with a third. So I might need 20 years income to protect my family. Then we look at mortgage. Do I want my mortgage completely paid off? And do I want my kids' education paid for? And when you look at the dime method, a lot of people come up to maybe $500,000 to 3 to 4 million. And I think they should look at how much coverage and make sure that amount is set inside. And then the second thing they should look at is the type of coverage. But first thing is dime. How much coverage do you need? And then, for example, if someone's single and they don't have an income to replace, or they're divorced and separated, the question is how much income would the children want as a supplement? So it could be a very wide variety of amounts. There's 2 main types. So you get the amount. Let's assume it's $500,000. There's 2 main types of insurance. There's term insurance and there's permanent insurance. They're wonderful. They're both great. The difference between term and permanent is not how long they last. It's something called cash value. That if it has cash value, it's permanent. If it doesn't have cash value, it's term. That's a rule of thumb. So let's look at some examples here of how does this work. Now, you'll see this a little purple line. And this purple line is really set up. It's called the cost of insurance. When you're young, it's typically very inexpensive. And when you're old and less healthy, it's typically more expensive. This is a rule when it comes to insurance. So let's look at some term. Term is a simple form of life insurance. It's like renting an apartment. The insurance company pays a death benefit should anything happen during the length of the term. There's different types of term. Now, anytime we're dealing with something that's marketable to the consumer, the more options the consumer has, the better. So you can have insurance that goes up every year. You could have insurance that goes up every 5 years, 10 years, 20 years, 30 years, 40 years, 35 years, 25 years. It's up to the client's need. Now, we should pick the length of the term based on how long the client's going to keep the policy. So what I mean is, if a client has for example, I have a 5-year-old, a 1-year-old, and a baby, yet to be born. So I might need a 20-year term insurance. If I have a 15-year-old, I might only need a 10-year term insurance. Or let's say I'm 50 and I'm going to retire at age 55. Maybe I need a 15-year insurance. So the length of term should depend on your need for insurance. And that's usually the need to protect income, pay off your debt, or to pay off your mortgage, or maybe the kids' education. When my kids turn 25 and I've paid their education, I may not need to continue to pay that. But that's how term insurance is priced. And we want to look at if it's 1-year term, 5, 10, or 20. 1 year is very common with inside a universal life. 5 years is very common for credit insurance. 10-year is very common if it's the cheapest policy. And 20-year term is the most common type of term sold by a licensed advisor, usually on a young family. Group insurance is usually an added bonus, but when you leave your group employer, you may also leave your insurance. And here's an example. This is a 30-year-old female. This example is in our book. It's on page 30. 30-year-old female, and it's $400 a year for a $500,000 coverage. So for the first 20 years, they pay $400 times 20 years, they put $8,000 in, and they have the expectation to get $500,000 out if they were to pass away. After 20 years, this is an IA policy. You can see down here, it goes from $2,000 to $2,100 to $2,300 to $2,600 because the client's getting older, and it goes from 20-year term to 1-year term. So after 20 years, the next 20-year terms would be $2,000 and up. So the first 20 years is very cheap. The second 20 years is not that cheap. It's actually quite expensive. But if you put this all together, you're still paying less than 100,000 for 40 years, and your death benefit would be 500,000. But when I look at the advantages of term, this is the number one advantage: low cost. If you need a lot of coverage, low cost. You could buy it, it's relatively inexpensive, and it covers a liability for a specific amount of time. Disadvantage, only a limited amount of time. The policy, if you miss a premium, you might lose the policy. If you don't pass away and cancel the policy, you feel like the premium is wasted. And then if you're uninsurable, you might have to get forced to renew at higher rates because you didn't lock in your rate. But the policy at a certain age, depending on the policy, cannot be renewed. So if you just keep it and keep it and keep it, you might age out. Because term insurance is a set period of time, you may live longer than the length of the term. So we look at, hey, is there a need for permanent insurance? The first question isn't, should I build cash value? The first question is there a need for coverage that lasts my whole life? And when I look at the need for coverage, I think when you're young and you say, hey, I need coverage while my children are young, then I need coverage to protect my spouse's retirement. But we have something we call the widow's gap. And the widow's gap means when I'm 85 and my wife is 85, I'm probably going to lose my OAS and my CPP, at least 40% of it, to my wife's not going to get that. So if we're living on a tight budget and I lose my government benefits because I died, my wife wants that repaid. And so a lot of times we look at maybe $2,000 a month for a year or two, or however long my wife might outlive me. I also might lose my pension might not transfer to her right away, so I might need 6 months there, and she might want to renovate my house before she sells it, so she doesn't have to sell it in an estate sale. So there's different needs when you're 85, but my number one need would be to take care of my bride, to say, hey, if I lose my income, I'll replace the government benefits. Instead of doing it with my savings, I could do it with my insurance. So I believe there is a permanent need for money, whether you use insurance or you use savings or you use other tools, it's up to you. But so if term insurance is like renting an apartment, permanent insurance looks like owning a home. You overpay in the early years to offset the cost in the later years. So there's still a cost of insurance is being paid, but instead of just paying a level cost and canceling it, you're intending on keeping it your whole life. There's two types of policies, a whole life and a universal life. The main difference is how your premium is calculated and how the cash value is calculated. Those are the two main differences. So a whole life is where part of your premium buys insurance, and that insurance can be sold back to the life insurance company. So the cash value is actually created by the value of the death benefit. Let me say it again, the cash value is created by the value of the death benefit. So it matters how much premium you have yet to pay. So if you still have a lifetime of premium to pay, you have low cash value. But if you've been paying premium for 20 or 30 years, your cash value goes up quite a bit because you've been decades from doing a medical. We don't know how healthy you are anymore. And at age 100 in a whole life, in a participating whole life, the death benefit and the cash value must be equal. So what happens is you pay more of the money in the beginning, so you don't have to pay later. And you get a fixed premium, and many people do a paid up feature. You get a quality interest rate on the cash value. This is compared to a fixed product. So for example, some companies pay upwards of 6+% as a dividend, and they've been doing that for 50 years plus 100 years. So we think that's a quality interest rate when you look at a bank rate. But if you're looking at money in the stock market, 6 might not be as exciting, but there's no risk here. You can access some of your cash value through different ways, like withdrawal, surrendering a policy, or a bank loan. Very much like a rental property, you can access some of your equity out. And your policy may receive dividends, and then you can buy more insurance. So let's just show you a policy real quick. This is a $500,000 policy. The dividend option is paid up additions, and the premium option is paid to 100. So it's not a 20 pay. And the premium is $500 a month or $6,000 a year, rounded off. So you say, okay, a 30-year-old female, similar to a TFSA payment, $500 a month. Now, it's a lot more than term, but you get a lot more. So let me show you the difference. If I own a policy like this and I put in $6,000 for 35 years, after 35 years, after 20 years, I've paid in 120,000 and I paid in about 180,000 at age 65, but my death benefit is 1.1 million. So I have a $500,000 starting death benefit, and that grows to about 1.1 million. Now, there's people out there that say you don't get your cash value and your death benefit. Your cash value in a whole life is like equity in a house. Your death benefit is 1.1 million. That's the value of the house. And you have 500,000 of equity in that house. Just like if I die, my wife would get my house, which is the equity and the mortgage. So if someone dies here, they get 1.1 million if they die at age 65. If they die at age 85, they might get 1.8 million. Now, one of the problems with a policy like this is if I put in $180,000 over a lifetime, what if my wife dies before me? What if my children die before me, or they don't like me, or I don't like them, something changes? At age 85, I could access the 1.4 million. Typically, a whole life, you get 90% accessibility of your death benefit. But it's a good deal if you keep it. If you cancel this in the 5th year, you're so far away from passing away, they only give you 2,000 back. So if you don't keep it, it's a losing policy. But if you keep it, it's actually quite a benefit to your family. Advantages: get a guaranteed interest rate. A lot of people who want guarantees go towards whole life. You could pay it off early so you don't have premiums in retirement. And it's a permanent policy, and there's no tax as it grows. Maybe people think they could be more aggressive and get a better rate of return. Then the premium is fixed unless you overfund it. You can overfund whole life or universal life. So let me just summarize. Term insurance, you're paying kind of the pure cost of insurance leveled out over 10, 20, 30 years, and then it jumps up. Whole life, you're buying your insurance up front, and there's a cash value based on the present value of a future death benefit minus unpaid premiums. Universal life is a combo. It's got the best and the worst of term and the best and the worst of whole life. So it's got the best and the worst of both of them. So basically, it's similar to whole life. It's a permanent policy. However, it has a flexible premium. Now, every time we give you something in insurance, like flexibility, we take something away. Every time we give you something like market returns, we take something away. So we want to know, how does this work? The cost of insurance is typically 1-year term, although there's different options. And the money you put in gets invested into a third-party fund. So you get a flexible premium. You actually have 3 numbers, not minimum, maximum. It's minimum, recommended target, and maximum. So I recommend that when you pay a premium on a universal life, you don't pay the minimum, you don't pay the maximum, but you do pay over the recommended target. Some premium goes to the cost of insurance, which is term, and the rest goes to a third-party investment fund. You get to choose which investment fund you want, and you can access some of the cash value later on. Now, if you're buying something to access the cash value, you want to put a little extra in, because the initial intention of the cash value is to pay future premium. So $500,000 policy, similar to a whole life, we're going to put $500,000 in. Now, we could just put $1,800 in a year or $150 a month. So let's look at an illustration. The illustration, no matter what type of policy you buy, looks good. That's the purpose of an illustration. This one looks a little more confusing. We have coverage year. Insured age is starting at 30. We assume a rate of return of 6. Now, that's based on the fund you choose. So you want to look at the track record of that fund. The annual charges here, if someone puts in $6,000, the annual charges are $386, and the rest of that money goes into the fund value. If you die, and this was the policy you set up, your family would get the $500,000 of insurance you bought that you paid $386 for, and they'd get the $5,600 on top. After 20 years, if you die, you get the 500,000 of insurance you bought plus 208. So you get 708. So you're just getting your term insurance plus your savings. So it's very simple that way. The annual charges, this skips every 5 years. So I just kind of made the form a little more condensed. If you're putting in premium and you put in 35 years, 180,000, you have a cash value of 500,000, 557. If you overpay, you hear, if the market does well, it kicks into a side account. So what we do is we end up stopping to pay to filter some of this back. So if you put in too much money, it's not good. If you put in too little money, it's not good. And then you can see the annual charges are about 3,000 a year here, similar to the term. And that comes out of your cash value. So 557,000 at 6% might produce 12,000 a year, or actually it would produce 50,000, 60, 25,000 a year, which could cover the insurance cost, no problem. But some of the pitfalls of universal life, if someone pulls out a lot of this money early in the policy, then they can't pay the later premium. So if you use it to retire early, you could actually be pre-spending your insurance premium dollars. But when you look at putting in 200,000 and getting out 1.2 million, when it comes to life insurance, if you keep it until you die, it works wonderfully. But if you cancel it before you die, it doesn't work wonderfully. It sounds like the insurance company wins. So if you really don't like insurance companies, buy a policy and keep it till you pass away. The advantage of a universal life is you get a flexible premium and you can add more money to increase your death benefit. You can access some cash value and some tax advantage growth. Now, a lot of times the cash value is usually used in an emergency, where I think the most common use that I've seen that's very healthy for life insurance is in a refinance situation, where if someone says, hey, I want to refinance my home, but I have too much credit card debt. We can pull money from a policy, pay off the credit card debt, go get the refinance on the home, and then put the money back in the policy, because it just cleans up their credit for a short period of time. If you underfund a policy, you may require more premium later in life. So if you say, I want to pay the minimum, or if you're converting a term, when a term renews, sometimes it's easier just to switch to a YRT, universal life. But you get a guaranteed interest rate. If you choose the guaranteed interest rate, it might be too low for the universal life to fund itself. Let's run through some of these options. Term insurance is flexible premium, and you can skip payments without the policy lapsing. This is false. Future term insurance renewal rates are higher, so that is false. Group term insurance may terminate if you leave their employment. True. Final expense, false. Now, a lot of people say, I don't like permanent insurance. But when they turn 70, we sell them a permanent policy because they want to say, hey, I need 20 grand for a funeral and maybe give a little bit of money out. So they still buy it. They just buy it at an older age. So it's a lot cheaper if you buy that final expense. It's almost zero when you buy it when you're 30 or 40 or 50, just to put that stuff in place. And then universal life has a flexible premium. True. Very true. Let's keep going here. Now, if we look at these different options, some of the things we got to know is all insurance has this same very inexpensive when you are young, very expensive when you are old. Term insurance, you're just paying the pure cost and leveling it for 10, 20, or 30 years. Whole life, you're paying the cost up front. And because you own the insurance and you own the contract, it creates a value that the insurance company will buy back to tempt you to cancel it. And then universal life is like a buy term invested difference, where you're commingling your insurance and your investments. I think it works really well to do a combination. So when you do a policy, it's actually, if I like the extra savings in universal life and I need $500,000 of coverage, many times we do, let's $100,000 permanent and $400,000 term. So I get the benefit of the universal life, but I might not need, I have over 4 million of life insurance. I might not need 4 million my whole life. but I do need some my whole life, but I'll probably cancel some when my children get jobs. And so when you look at different riders, a rider is something you can add to the policy to give you extra benefits. So some of the riders that we can add are things like additional term. So I can buy a permanent policy, a small permanent policy to keep my premium from blowing up, and then I can add term to get to my dime. Or I can add critical illness and disability. Waiver of premium is probably the least utilized in the insurance industry, where what it means, if I do a bigger policy, I do a waiver of premium in case of disability, where if I say, if you got disabled, your premium, your insurance is covered. You're not going to lose your estate plan because you got disabled. Your inheritance still goes to your kids. And I can cover my children. On a child, you can do guaranteed insurability, where my children don't have to do a medical when they're older for insurance purposes. So we can add different things. Let's go through a few of the benefits. It's tax-free to the family, tax-free living benefit, tax-free growth in a policy. So there's no tax as you're building the policy. And you can take money out up to your ACB on a policy loan with no tax. On the bottom here, if you uncouple a policy, you take the investment and the insurance and you uncouple it, the uncoupling or surrendering of a policy, you get paid the cash value. It's a taxable event if the policy is growing. So if there's a lot of growth in the policy, we don't want to cancel policies. We want to try to keep them until we die. Should I buy an insurance on kids? Hey, we buy lots on our children and we sell lots. You know, if a child becomes critically ill, a $250,000 critical illness is about $50 a month. And so I think if my children get sick, I like the idea of having a coverage on them. If my wife gets sick or has a disease or passes away, I like the idea of coverage. Single people buy lots of it. And a lot of times it just depends on the person. We don't have to come up with reasons for people to buy insurance. We say, this is how much it costs. This is what it is. And then people say, I'd like to buy that. I'd like to protect my family. I'd like to do this or that. And then if you're uninsurable, we have options that have less medical questions that can give you options to get insurance. So, you know, we look at insuring the kids. I think you can buy a policy on a child. I think it's a good thing. There's 4 things we can put onto a policy. We can do a permanent life insurance. We can do extra payments to cash value. You can do critical illness, and you can do guaranteed insurability. Those are the 4 pieces that I'd like to see on a policy. Critical illness, we can do as a rider, or we could do as a standalone piece, where it covers you. 70% of the claims are cancer, and 20% are cardiac or heart issues. So we sell lots of this to single people, and especially single females. And we basically ask, like, hey, who's going to take care of you when you're old if you don't have money? So they buy a policy to say, hey, when I get old, I don't want my family changing my diaper. I don't want my family pulling me out of the bathtub. I want to pay someone, a professional, to do that. And so then the last 1 or 2 years, if someone gets cancer, they can live in dignity because they have a little bit of money set aside. So critical illness is a major concern for a lot of people. And that way you can see the right doctor, take time off work, different options. If you become disabled and you cannot work, critical illness doesn't trigger if you can't work. It triggers if you get diagnosed. Disability triggers if you can't work. And so an employer plan pays out first before an individual plan. But if you're self-employed or you don't have an employer plan, I think owning a personal disability makes a big difference. And basically what it is, if I can't work, my disability policies will cover my income. We buy lots of different insurance, whether it's health insurance if people are traveling. A lot of times people have this at work, but when they retire, they lose it. And so you want to look at how much you pay and what you get. A lot of it depends on whether you use it on a regular basis or not. And then travel insurance covers medical emergency. I know of 2 emergencies that we paid claims on. One is a heart attack, and it was about $75,000 of costs. And someone else had a motorcycle accident in Europe, and we paid all that stuff. It was a $75 deductible, and the rest is paid. The insurance company flew the mom out, stayed with them for about 3 weeks in the hospital, and they all flew back together back to Canada. But this type of stuff, as you travel into another country, you want to look at, hey, should I get the coverage? This is a big big no here. It says mortgage insurance will pay off your mortgage if you should become seriously ill. But bank staff may not be licensed. Premium typically decreases. Premium stays the same, but the death benefit decreases. So as you pay your mortgage off, because you coupled your mortgage and your life insurance, as you pay your mortgage off, you're also paying off your life insurance. So then if you got sick, you can no longer pay off your mortgage because you don't want to have zero insurance. So we don't want to couple our mortgage with our insurance. If you do a fully underwritten plan where we do a medical before we give you the policy, it's usually a lot cheaper. And so in mortgage insurance, they do the medical usually after you pass away. Sounds crazy, but it saves them a lot of money because they don't qualify you to claim, they qualify you to pay premium. If you go on YouTube and search the YouTube video In Denial, there's a great video about how this works that CBC put together. I think it's very accurate. What if I can't get insurance? What if I've been declined? What if I have a bunch of health issues? Well, we have what's called simplified life insurance, which means we have a list of maybe 30 questions. And every time you ask them 5 or 10 questions, you're allowed to buy more coverage. So if you can only answer 5 questions, you're only allowed a small policy. But if you can answer 30 of 30, you get a bigger policy that's cheaper. So you can still get insurance. It's always at what price. If someone is 40, we might price them as an 80-year-old if they have a bunch of health issues. So when it looks at life insurance, maybe people think, hey, I got it through work. That is always, if you plan on working your work until you die, that works. But most people plan on leaving their employment. In fact, that's one of their goals in life. Why is it so cheap? Why is it so costly? It depends what you're paying for. There's many factors when it comes to insurance, and you want to review, what do I pay? What do I get? Who's taking the risk? What do I pay now? What do I pay in the future? And make sure you understand what their options are. And I don't think there's a major problem with universal life, with term, with whole life, when you look at combining them, because I think the main problem is the confusion, that people are confused on how it actually works. And so we want to look at your responsibilities. We want to look at, do you want benefits that help your overall financial strategy? One of the questions we ask about is, does someone have self-insurance? If I saved $1 million, I still want insurance. Just like if I saved $1 million, I still want fire insurance on my home, car insurance on my car, and I want my life to be repaid if there's a loss. Not could I afford the loss, but my wife would like to have my money and insurance. And I look at permanent insurance as really allows my children to spend the life insurance money, waste it, so when they get my inheritance, they can spend it maybe a little bit more responsible. Here's the quiz. What's best for you? This quiz is kind of misleading because usually we do a combination of a little bit of whole life, a little bit overfunding, a little bit of term, or a little bit of universal life, a little bit of overfunding, a little bit of term. That's very common. Term is your limited income. You want to protect your family. We want to quote term. And if you're in our industry, many times I think we confuse an objection with that we didn't recommend the right product. So if someone has a limited income, I say, here's what the term is. You have a young family, very limited income, you should buy the term. And they say, what about when I'm old? I say, well, you got to build some income, get out of debt, and we'll upgrade it. Or they say, a whole life, you got a policy guaranteed for life at a guaranteed rate. Now, if someone thinks they can do a better rate long-term, they're very sophisticated, they love learning about investing, maybe I don't want to recommend a whole life except if it diversifies their portfolio. And then universal life is a policy for life and flexibility, but I want to recommend this to someone who is very comfortable having money exposed to passive investments like the stock market or mutual funds, or we can do an index fund. But they want to say, hey, this makes sense to me, I want to buy it. And if we get a recommendation right, and we answer basic questions, it's very easy for people to move forward. I think having a power of choice is a big deal nowadays. So I can say we can do simple issue, we could do permanent, term, CI, and we should look at a holistic approach that looks at someone's entire situation. We just did one in the office today where a client bought two critical illness policies because their maximum they could buy is 50,000 each company. So they say we want to buy 100,000 and get a couple different policies as opposed to a combo. But I think when people understand how this works, if you go online, there's lots of controversy about insurance. Which one's good? Which one's bad? The question is, which one do you own? And are you going to own it until you pass away, or do you plan on canceling it? If you own permanent and plan on canceling it, you're probably better off doing something else. But if you own term and you plan on keeping it, you probably should convert it sooner rather than later. So we can't tell you what's good unless you tell us what you wanna, what the tool is being used for. I want to be a part of the 30 million educated. And when I look at educated, I think of educated to do what? Educated for me, I used to think educated to save $100 a month or 500 a month or 2,000 a month. And then I thought I wanted to be educated to save 50,000 and get debt free and buy a home. And what do I want to be educated to do? And I think now I'd like to be educated to make $1 million a year and save $1 million. I think that's what I'd like to learn how to do. I'm not there yet, but I start thinking, hey, if that's possible, why not me? Why don't I figure that out too? But we have different workshops. I would recommend if you enjoy this workshop, come to more workshops and educate yourself both on how the financial industry works and possibly how you could maybe start a career in the financial industry if you want a career in the financial industry. If you don't think you want to work in our industry, then don't start a career in our industry. It may be a big headache, but it's been a blessing to me. And can you reach out to the person that invited you out? Or if you're already a professional, tell someone in your office, hey, I was in a workshop. This is what I learned. This is what I'm going through. And they could answer your questions to help you have a better understanding of how to apply some of this stuff. And so that you could be in control of exactly what you're doing. What do you see? There we go. But this is all we have for myself today. This is our workshop. And if you have any questions, I can take a basic question, but typically I want you to ask all your questions to the person that invited you out. That's what they're hoping for, that you can maybe bring it up in a conversation for them. It makes it a lot easier. So my name is Daniel Fehr-Krahn. We got a couple of questions on text. Someone said there is no sound. Maybe that is them, not me, I hope. I pray. But my sound appears to be on. So thank you so much for coming out.